78. 5. Riders and supplementary benefits. This chapter covers the most common riders and supplementary benefits that can be added to life insurance policies. While the terms riders and supplementary benefits are often used interchangeably, riders provide additional benefits upon death, and supplementary benefits provide benefits before the death of the life insured. Collectively, riders and supplementary benefits are the extras that can be added to customize a policy to better address a policyholder's unique needs. Riders and supplementary benefits are usually added at the time of issue, although sometimes they can be added to an existing contract. Most riders and supplementary benefits can apply to both term insurance and permanent insurance policies. Riders and supplementary benefits typically require the payment of additional premiums and, with the exception of the paid-up additions rider, they do not increase the policy's cash surrender value. 5.1 Riders that provide additional benefits upon death. Riders can be used to expand upon the death benefit offered by the base policy. They are discussed in the following order. Black small square paid-up additions, PUA, rider. Black small square term insurance riders. Black small square accidental death, AD, rider. Black small square guaranteed insurability benefit, GIB, rider. 5.1.1 Paid-up additions, PUA, rider. A paid-up additions, PUA, rider allows the policyholder of a whole life or universal life, UL, insurance policy to pay additional lump sum premiums to buy small amounts of paid-up permanent life insurance during the lifetime of the base policy. These PUAs increase the death benefit and the cash surrender value, CSV, of the policy. This is similar to the PUA dividend option under a participating whole life insurance policy, where policy dividends are automatically used to purchase additional amounts of paid-up insurance. The PUA rider is underwritten at the same time as the base policy, so no additional evidence of insurability is required when the policyholder purchases the PUAs. However, the insurance contract usually places limits on the rider, such as black small square the minimum PUA that can be purchased at any one time. Black small square the maximum PUAs that can be purchased in any 1 year. Black small square the cumulative maximum PUAs that can be purchased over the life of the policy. Black small square when the policyholder can purchase PUAs, example, on policy anniversary. Black small square the maximum age of the life insured at the time of purchase. The minimum PUA restriction is to reduce administrative expenses associated with the purchase. The remaining restrictions ensure that the policyholder does not wait until his health fails before making a significant increase in coverage. Example. Valerie is a business professional and she is the main income earner for her family. She expects her salary to increase at a rate of 5% per year. She has a $500,000 whole life insurance policy with a PUA rider. Under this rider, she is permitted to buy additional coverage of $10,000 per year for the next 20 years, without proving her insurability, by making lump sum payments. She likes this option because she can increase her coverage as her salary increases. She is not required to purchase the additional coverage in any 1 year, but if she does not do so, she cannot carry that purchase forward, i.e., she cannot purchase $20,000 of coverage in the following year. 5.1.2 Term insurance riders. A term insurance rider adds additional coverage for death, over and above that provided by the base policy, for a limited period of time, i.e., the term. The term insurance rider can apply to the life insured under the base policy, i.e., the primary insured, or it can apply to someone else. In the latter case, the coverage on the additional person is underwritten separately from the coverage on the primary insured under the base policy. The amount of coverage on the term insurance rider is independent of the coverage provided by the base policy, and can in fact be for a greater amount. A term insurance rider cannot have a term that exceeds the term of the underlying policy. Once the base policy expires, so does the rider. If this is a concern, the policyholder should look for a term insurance rider that has a conversion option, so the rider coverage can be converted to a stand-alone policy upon expiry of the base policy, without having to provide proof of insurability. There are several variations of term insurance riders, as discussed below. 5.1.2.1 On a term policy. It is quite common for term insurance riders to be added to term insurance policies. For example, the family or child coverage riders discussed later in this section could be added to a term insurance policy. The primary reasons for covering these additional people with a rider instead of obtaining coverage under a separate policy are convenience and cost. By using a rider, the policyholder only has to manage a single policy and pay one premium. It also reduces the administrative fees paid by the policyholder. The premiums for most life insurance policies include an annual policy fee, typically in the order of $50 to $100, to help cover the costs of administering the policy. The policy fee is usually a fixed sum regardless of the amount of coverage provided, and it is usually not affected by the addition of one or more riders. 5.1.2.2 on a permanent policy. Often a policyholder will have a mix of long-term and short-term insurance needs. To satisfy both needs, that person could buy some form of permanent insurance to cover the long-term needs, along with a term insurance rider to cover the shorter-term needs. Example: Zoltan is a business owner and he hopes to pass his business on to his children when he dies, but he expects that a tax liability of $500,000 will result at death. He also has a $200,000 mortgage with 10 years remaining that he would like to have paid off if he dies. The insurance need with respect to the mortgage has a specific duration, 10 years, that could be covered with term insurance. The insurance need with respect to the business shares has no defined time limit, so permanent insurance might be appropriate. Zoltan could cover both needs by acquiring a $500,000 whole life insurance policy with a 10-year $200,000 term insurance rider. This would be more cost-effective than paying for a $700,000 whole life insurance policy. 5.1.2.3 Family Coverage Rider. The family coverage rider is a common addition for policyholders who have a spouse and children. It is sold in units that cover all eligible family members, i.e., the spouse and all eligible children. For example, a unit might provide coverage of $5,000 for the spouse and $1,000 for each child. The insurance company normally limits the number of units that can be purchased under the rider, but that limit is usually sufficient to cover or at least offset the funeral or burial expenses the policyholder might incur upon the death of a spouse or child. Life Insurance 81 Chapter 5, Riders and Supplementary Benefits. The family coverage rider is underwritten based on the spouse's attained age when the rider is issued. The spousal coverage usually will not extend past a certain age, such as 65. The number of children covered under a family coverage rider does not affect the premium. Once the rider is in place, every child in the family, including adopted children, is automatically covered once they reach 15 days of age, without any increase in the premium. Death during the first 2 weeks of life is not covered under this rider. The coverage usually continues until the child reaches a certain age, such as 21 or 25. Example: Kant. Valerie's husband, Robert, is a stay-at-home father, taking care of their 2-year-old twins, Rebecca and Charlotte. Valerie is currently 7 months pregnant, but she intends to return to work 4 months after giving birth. Robert's role as caregiver is essential to the financial health of the family, particularly until the children are in school full-time, so Valerie added a family coverage rider to her whole life policy, for $100,000 of term coverage on Robert, and $20,000 of coverage on each of Rebecca and Charlotte. When their son is born in a few months, he will automatically be covered for $20,000 under the rider once he reaches 15 days old, and Valerie's premium will not increase. 5.1.2.4 Child Coverage Rider. If the policyholder wants to obtain coverage for his children but he does not have a spouse, or does not want to obtain coverage for his spouse, he can add a child coverage rider to his individual insurance policy. Like the family coverage rider, every child is automatically covered once they reach 15 days of age, without any increase in the premium, and coverage continues to a specific age, such as 21 or 25. The amount of child coverage is limited to the maximum specified by the rider. The death benefit can be used to offset the funeral or burial costs the policyholder may incur upon the child's death, or for other purposes. 5.1.2.5 Converting child or family coverage riders. A child who is covered under a child or family coverage rider usually has the option of converting that coverage to individual permanent life insurance. The option is usually available at any time while the rider is in effect, up until coverage under the rider expires. The child does not have to provide proof of insurability. Some riders allow the child to obtain up to 5 times as much coverage as that provided by the rider itself. The premium for the individual coverage will be based on the child's attained age when the new policy is issued. The family coverage rider on Valerie's policy will cover each child until age 25, and it gives each child the right to convert the term coverage to a whole life policy with a face amount of up to 5 times the term coverage, or $100,000, without providing proof of insurability. Rebecca has a congenital heart defect that increases her risk of premature death. As long as Rebecca acts before the term insurance coverage expires at age 25, she can still obtain $100,000 of whole life coverage even though she may otherwise be uninsurable. This same conversion option is usually available to a spouse who is insured under a family coverage rider, although the coverage amount will probably be restricted to the amount covered under the rider. 5.1.3 Accidental Death, AD, Rider. A life insurance policy with an accidental death, AD, rider will provide an extra benefit, over and above the regular death benefit, if the life insured dies as a result of an accident. Depending on the insurance company, AD rider coverage may be offered in units, example, in multiples of $25,000, to a specified maximum, or it may be a multiple of the death benefit. The most common multiple is 2 times the death benefit, and as a result this rider is sometimes referred to as double indemnity. An accidental death is one that occurs as a result of an unexpected violent or traumatic event. To qualify for the AD benefit, the death must occur within a fixed time after that event, example, 1 year. The AD rider typically excludes deaths resulting from suicide, self-inflicted injuries, war, or the commission of a crime. Only deaths resulting from accidents are covered, deaths resulting from sudden illnesses are not. Sometimes it may be difficult to determine if the death was caused by an accident or natural causes. In this case, a detailed autopsy and analysis of the circumstances leading to death would be required. Example: Janet had a $250,000 whole life insurance policy with a rider that doubles her death benefit for accidental death. She was found dead at the wheel of her car after it struck a concrete bridge. Her autopsy showed that she suffered a mild heart attack, which likely contributed to the accident, but that ultimately she died as a result of injuries sustained in the crash. Janet's beneficiary will receive death benefit proceeds of $500,000. However, if the autopsy had shown that Janet had died instantly from a massive coronary event, her beneficiary would likely only receive the original $250,000 death benefit. AD rider coverage may be limited to certain ages, even if the base policy is not subject to the same limitations. For example, Black small square the policyholder may have to apply for AD coverage before the life insured reaches a certain age, such as 55. Black small square the AD coverage may only continue until the life insured reaches a certain age, such as 60. Black small square the AD coverage may be reduced once the life insured reaches a certain age, such as 65. AD benefits are often packaged along with accidental dismemberment benefits, which are discussed separately in the section Supplementary Benefits. If the rider offers coverage for both accidental death and accidental dismemberment, it is called an accidental death and dismemberment (AD&D) rider. 5.1.4 Guaranteed Insurability Benefit (GIB) rider. A guaranteed insurability benefit (GIB) rider gives the policyholder the option to buy additional life insurance coverage in the future without providing proof of insurability. The premiums for the additional insurance will be based on the attained age of the life insured at the time of the addition, but will assume that his health remains the same. A GIB rider is very useful for those who currently do not have a large insurance need, or who cannot currently afford a larger amount of insurance, but expect they will want to increase their coverage in the future. By adding a GIB rider to a term or permanent policy now, they are guaranteed the right to increase their coverage even if their health declines. Example: Doug recently got engaged, and he and his fiancée Noma plan to have several children. Doug is only 25 and his cash flow is tight, but he knows that he will need a fair amount of insurance protection once they start their family. He purchased a 10-year $300,000 term policy now, along with a GIB rider that will allow him to increase his coverage by up to $20,000 each year. GIB riders normally include a number of restrictions, such as Black small square the option to increase the coverage may only be permitted at certain times, such as within 1 month of each policy anniversary. Black small square the amount of each increase may be limited to a specific dollar amount or percentage of the original face amount. Black small square the total increase may be limited to a specific dollar amount or percentage of the original face amount. Black small square the number of times the option can be exercised may be limited, such as 5 times over the duration of the contract. Black small square the option to increase coverage may only be available until a certain age, such as 50. 5.2 Supplementary benefits, benefits in addition to the death benefit. Supplementary benefits are those that may be available before the death of the life insured. They may or may not affect the death benefit that is paid upon the death of the life insured and are discussed in the following order. Black small square accelerated death benefits. Black small square accidental dismemberment benefit. Black small square waiver of premium for total disability benefit. Black small square parent/payer waiver benefit. 5.2.1 Accelerated death benefits. When accelerated death benefits are added to a life insurance policy, the insurance company will pay out a portion of the death benefit prior to death of the life insured, if certain conditions are met. Accelerated death benefits are sometimes also referred to as living benefits. There are 2 types of accelerated death benefits, discussed below. 5.2.1.1 Terminal illness, TI, benefit. A terminal illness, TI, benefit allows the policyholder to apply for an advance on the death benefit if the life insured has been diagnosed with a terminal illness that is expected to result in death within a fixed period of time, such as 1 year or 24 months. The request must be supported with a diagnosis and prognosis made by a qualified physician. Many insurance companies build the TI benefit right into their insurance policies. If this is the case, the policyholder does not have to pay an extra premium. Some insurance companies will even extend this benefit on compassionate grounds, even if it is not a contractual obligation. The TI benefit is usually restricted to a maximum amount, which may be expressed as percentage of the original face amount, ranging from 25% to 75%, and/or a dollar limit, example, 50% of the face amount to a maximum of $50,000. The TI benefit is payable to the policyholder, regardless of who is named as the beneficiary of the life insurance policy. If the beneficiary designation is irrevocable, the policyholder will have to obtain the beneficiary's permission before applying for a TI benefit. Because it is an advance of the death benefit, and death benefits are generally not taxable, TI benefits received by the policyholder are tax-free. The TI benefit reduces the death benefit paid upon the death of the life insured. Some insurance companies structure the TI benefit as a loan at a fixed rate of interest, where the loan is secured by the death benefit. In this case, the death benefit will be reduced by the loan amount plus cumulative interest. Example: William has a $500,000 term life insurance policy on his own life, with his wife, Alyssa, named as the revocable beneficiary. He bought the policy to help Alyssa maintain the family's standard of living if he died prematurely and the family no longer received his employment income. The policy provides for a terminal illness benefit of up to 25% of the death benefit, to a maximum of $100,000. Unfortunately, William was recently diagnosed with a terminal form of cancer and he is no longer able to work. His oncologist has told him that he will likely die within 6 to 12 months. Alyssa has reduced her work hours to help care for William and to spend more time with him. To help compensate for their loss of income, William applied for, and received, a non-taxable terminal illness benefit of $100,000. When he dies, Alyssa will receive a death benefit of $400,000, which is the original face amount of $500,000 minus the TI benefit of $100,000. 5.2.1.2 Dread disease, DD, benefit, aka critical illness or CI benefit. The dread disease, DD, benefit allows the policyholder to receive a benefit if the life insured is diagnosed with one of the conditions specified by the contract. The life insured does not have to be in danger of dying as a result of the condition, but the diagnosis must be supported by a qualified physician. The conditions covered will vary with the insurance company and the contract. Most policies will cover the Big Four: heart attack, stroke, coronary bypass surgery and life-threatening cancer, but many policies cover other conditions as well. In fact, the number of covered conditions may be as high as 25 or even more. The policyholder should review each policy carefully to understand what is covered and what is not. The DD benefit is usually paid out as a lump sum once the life insured has survived for a specified period of time after the diagnosis, such as 30 days. Because it is an acceleration of the death benefit, it is not taxable. Scott has a $500,000 whole life insurance policy that includes a $100,000 dread disease benefit. He recently suffered a stroke that has left him almost fully paralyzed. Provided that he survives at least 30 days following the stroke, he can apply to receive the DD benefit of $100,000. The conditions under a DD benefit may be similar to those covered under an individual critical illness (CI) insurance policy. In fact, the dread disease benefit is sometimes referred to as a critical illness benefit. This CI-like coverage may allow the policyholder to save money compared to buying separate life and CI policies. The terminology used by various life insurance companies is often inconsistent and can be confusing. If a life insurance policy uses the term critical illness benefit or critical illness rider, the policyholder should read the terms of coverage carefully. If the amount paid out when the insured suffers a covered condition reduces the death benefit, the policy is offering an accelerated death benefit in the form of a dread disease (DD) benefit. If the amount paid out when the insured suffers a covered condition does not affect the death benefit, i.e., it is paid in addition to the death benefit, it is not an accelerated death benefit and is likely a critical illness rider for which an additional premium must be paid. 5.2.2 Accidental Dismemberment Benefit. The accidental dismemberment benefit is usually found coupled with the accidental death (AD) benefit discussed earlier in the section Accidental Death (AD) rider. Together they form the Accidental Death and Dismemberment (AD&D) rider. An accidental dismemberment benefit is a lump sum amount that will be paid if the life insured loses a specific body part or body function as a result of an accident. The losses, and the resulting lump sums, that are payable as a result of each loss are typically laid out in a schedule of loss, such as the sample shown in Table 5.1. Life Insurance Chapter 5, Riders and Supplementary Benefits 87. Table 5.1, Sample Accidental Death and Dismemberment, AD&D, Schedule of Loss 10. Asterisk the maximum payable for any one accident or event is limited to 100% of the death benefit. The accidental dismemberment benefit will only be paid out if the loss occurs as a result of an unexpected violent or traumatic event, within a fixed time, example 1 year, of that event. Losses incurred via self-inflicted injuries, war, or the commission of a crime are generally excluded. 5.2.3 Waiver of Premium for Total Disability Benefit. Under the waiver of premium benefit, the insurance company will waive the premiums on the life insurance policy, including premiums for any riders or supplementary benefits, if the life insured becomes totally disabled. 11 The definition of total disability varies with the policy. For example, total disability might be defined as the life insured being unable to carry out his regular employment for the first 2 years of disability, and unable to do any other job thereafter for which he is reasonably qualified by education, training, or experience. While premiums are being waived, benefits continue to accrue under the policy. This means that dividends will continue to be paid. If it is a participating policy, cash values may continue to grow, and all riders and supplementary benefits remain in force. 5.2.3.1 Waiting period. Premiums will only be waived once the life insured has been disabled for the waiting period specified in the policy. Some policies provide for a retroactive waiving of premiums to the start of the disability, while others only waive premiums that come due after the waiting period has expired. 5.2.3.2 Renewable or convertible term policies. If the base policy is a renewable term insurance policy, then the premiums will continue to be waived after renewal. If the base policy is a convertible term insurance policy, at the end of the term the policy will be converted to a whole life policy, and premiums will continue to be waived for life, or as long as the life insured is disabled. 5.2.4 Parent/Payer Waiver Benefit. The parent waiver benefit, if the life insured is the policyholder's child, or payer waiver benefit, if the life insured is someone other than the policyholder's child, operates much like the waiver of premium benefit that was just discussed, with 3 notable differences. Black small square Depending on the policy, premiums may be waived upon the policyholder's death, as well as upon his total disability. Black small square because the policyholder is not the same person as the life insured, the policyholder will have to provide proof of insurability for himself as well as for the life insured. Black small square if the life insured is a child, some policies will state that premiums will be waived until the child reaches a specified age, example 18, 21 or 25. 11. The waiver of premium for total disability benefit may be applied if the policyholder is also the life insured. If the policyholder is not also the life insured, then the policyholder should consider adding a parent/payer waiver, discussed in the following section. Anwar is the primary income earner in his family. His wife Anya currently cares for their 3 children, who are all under the age of 5. He has a $1 million whole life insurance policy on his own life. He also has a $300,000 term life insurance policy on Anya's life because he knows that he would have to hire someone to care for their children if she were to die. He is the policyholder. He has added a waiver of premium for total disability benefit to the policy on his own life, and a payer waiver benefit to the policy on Anya's life, to ensure that both policies will remain in place if he becomes totally disabled. 5.3 Using riders and supplementary benefits to customize coverage. A policyholder can add riders and supplementary benefits to his base insurance policy to customize or enhance the coverage. This section explores some of the things a policyholder should consider when determining if these extras are appropriate for him. 5.3.1 Cost of coverage. Each rider or supplementary benefit has a cost associated with it, and in most cases this results in an additional premium for the policyholder. A few of the benefits, such as the terminal illness benefit or the waiver of premium upon total disability benefit, may be built into the base policy, but the policyholder is still paying for those benefits through his premiums for the base policy because the insurance company will have factored those costs into them. Sometimes the coverage provided by a rider or supplementary benefit is also available as a standalone product, example, a term insurance rider or critical illness benefit. Usually the coverage via rider or supplementary benefit will be cheaper than the standalone product because only one policy fee will be charged. The insurance company may also have lower underwriting costs because they can use the same medical information for both products. 5.3.2 Value of coverage. Of course, a rider or supplementary benefit only has value to the policyholder if it provides the protection he needs, at a reasonable cost. Consider the accidental death, AD, benefit. Is the policyholder's need for coverage going to be different if the life insured dies from natural causes than if he dies as a result of an accident? The tax liability upon death is going to be the same, and the survivors are going to have the same income needs regardless of how the life insured dies. If an insurance needs analysis shows that insurance protection of $500,000 is needed upon death, should the agent only recommend coverage of $250,000 in the base policy, plus an AD rider that would pay double the benefit if the life insured dies from an accident? Generally, the answer would be no. The full need of $500,000 should be covered regardless of the manner of death. However, if the policyholder cannot afford the premiums for a $500,000 policy, a $250,000 policy with an AD benefit might be a good compromise. The policyholder also needs to determine if it is coverage he can count on, so he should consider any limitations or exclusions that apply to the riders or supplementary benefits, as discussed below. 5.3.2.1 Limitations. The policyholder should be aware of what conditions would trigger payments under a rider or supplementary benefit, and what the limits on those payments would be. For example, black small square under the accidental death, AD, rider, what is considered to be an accidental death, and what time limits are involved. Black small square under a family coverage rider, when is a child eligible for coverage, and when does that coverage cease? Black small square under a guaranteed insurability benefit, GIB, by how much can the coverage increase and when are those increases allowed? Black small square what is the maximum amount that can be added under a paid-up additions, PUA, rider? Black small square which health conditions are covered under a critical illness, CI, benefit? 5.3.2.2 Exclusions. The policyholder should also be aware of those conditions under which payments would not be made under a rider or supplementary benefit. For example, accidental death and dismemberment, AD&D, benefits may not be paid if the death or dismemberment occurred as a result of self-inflicted injuries, during the commission of a crime, or as a result of war. These same exclusions often apply to the disability income (DI) benefit, the waiver of premium for total disability benefit, and the payer/parent waiver benefit. 5.3.3 Differences between companies. The death benefit provided by life insurance operates the same way across insurance companies. If the life insured dies, the death benefit is paid, less any outstanding policy loans. The amount of the benefit and the way the benefit is triggered is pretty black and white, without room for interpretation. However, the various riders and supplementary benefits that can be added to a life insurance policy vary greatly between companies, and even between life insurance products issued by the same company. Black small square Elias decided to take Company A's insurance policy because the waiting period imposed for the waiver of premium benefit is 3 months and not 6 months as imposed by some other insurance companies. Black small square Jackson would like to obtain the maximum dread disease (DD) benefit possible. He compares companies A and B. He decides on Company B because it provides a DD benefit of 50% of the face amount as opposed to 25% provided by Company A. Black small square for family history reasons, it is very important for Cindy to find a DD benefit that covers Alzheimer's. Company B does not, but she is happy to see that Company A does. So when policyholders are comparing life insurance policies between companies, they should also pay close attention to the terms and conditions of the riders and supplementary benefits. 5.4 Advantages and disadvantages of riders and supplementary benefits. The advantages and disadvantages of riders and supplementary benefits are summarized in Table 5.2. Table 5.2. Advantages and disadvantages of riders and supplementary benefits. Advantages, disadvantages. Black small square can be used to customize coverage to meet policyholders' unique needs. Black small square some benefits may be cheaper when acquired via a rider or supplementary benefit than when acquired as a standalone policy. Black small square conversion to individual standalone coverage without proof of insurability may be possible for term insurance riders. Black small square may give the policyholder access to higher coverage later, without providing proof of insurability, for GIB and PUA riders, while allowing him to pay for a lower amount of coverage now. Black small square additional premiums are usually required. Black small square there may be limitations and exclusions on coverage. Black small square coverage expires when the base policy expires. Black small square depending on the benefit, separate underwriting on the life insured and the policyholder may be required. Chapter 6, Group Life Insurance. Competency component Black small square analyze the available products that meet the client's needs. Competency subcomponent Black small square analyze the types of contracts that meet the client's needs. Life Insurance Chapter 6, Group Life Insurance 93.